If you buy AAA bonds, there's only one way to go. AAA bonds are bonds that everybody thinks are great. Their companies are making a lot of money. They have prudent balance sheets. The outlook is good. Everything's perfect. So if everything's perfect, that means it can't get better. And if it can't get better, that means it can only get worse. It doesn't have to get worse. But if there is a change, it's going to be for the worse. And if you've bought a bond on the assumption that it's perfect and it gets worse, then you lose money. So that's important. On the other hand, he said, if you buy single B bonds and they survive, there's only one way for them to go, which is upgrade. Now, that's not exactly true because they can default and go bankrupt. But the ones that survive will go up, will be upgraded, and the surprises are likely to be on the upside. So this was very important. Again, this is about trying to hit winners, avoid losers. And if you're buying bonds that most people don't think much of, it's hard to have a big loser because such low expectations are incorporated. Now, let me digress for a minute because this is really important. How do you make money as an investor? The people who don't know think the way you do it is by buying good assets, a good building, stock in a good company, or something like that. That is not the secret for success. The secret for success in investing is buying things for less than they're worth. So if you buy a high-quality asset, you know, and I say in the book, there's a guy on the radio, I used to, when I lived in LA, I listened to NPR on the way to work. And there was a guy and I heard him say it. He said, well, if you go into a store and you like the product, buy the stock. This couldn't be more wrong. Because what determines the success of an investor is not what he buys, but what he pays for it. And if you buy a high-quality asset, but you overpay for it, you're in big trouble. And you can buy a very low-quality asset, but if you pay less than it's worth, chances are you're going to make money. So the book says, chapter 3 says, the most important thing is value, figuring out what the value of an asset is. But chapter 4 says the most important thing is the relationship between price and value. So let's assume that you're able to figure out the value. If you pay more than that, you're in trouble. If you get it for less, the wind is at your back. So it was very, very important then to be in an area where the surprises were likely to be on the upside. And if you buy the bonds of B-rated companies about which there are such low expectations, maybe it's easy for there to be a favorable surprise. Now, I drove here from the airport in my car. And if I take you outside to look at my car and I offer it to you for sale, because I don't need that car anymore. When I'm done here, I'm not coming back. If I say to you, would you like to buy my car? What is the one question you must ask me before saying yes or no? Price. You get an A. You get an A. So, in other words, it's a good buy at a certain price. It's a bad buy at another price. Moody is now saying that B-rated bonds are a bad buy without any reference to price. So in other words, there's no price at which a company that has some credit risk is worth investing in. And I explained at lunch how if you bought the bonds of Hewlett-Packard, PerkinElmer, Texas Instruments, Merck, Lilly, Xerox, IBM, Kodak, Polaroid, AIG, Coca-Cola, and Procter & Gamble, and if you bought them all in '68 and you held them until '73, you lost 90% of your money. Why? Because they were overpriced. The average stock since the post-war has traded at 16 times its next year's earnings. These were trading at 80 and 90 times. Why? Because they were so good. Everybody says, these are great companies, nothing can go wrong, so it doesn't matter what price you pay. And if you pay 80 or 90 times, that's fine. Here we are, in my experience, again, experience as a teacher, you invest in the best companies in America, you lose a lot of money. Then you go to the high yield bond business, you invest in the worst companies in America, you make the most money. So it's an instructive lesson if you have your eyes open and you learn from experience.